Distinguished guests, ladies and gentlemen, good afternoon from me. As Greg said, my name is Arthur Whiteman and I lead PwC's insurance practice both here in Bermuda and across the Caribbean. I look forward to speaking at greater length to you tomorrow, but firstly I'd like to thank Greg and his colleagues at S&P for their continued support and co-sponsorship of this event, and also my team at PwC. After 8 years, we are still going strong, and this event has always been about assembling leaders in our industry to advance the debate on where the industry must go. And this year is no different. Thank you to all of you for your support. And so it is with great pleasure that I welcome to the stage Bermuda's Minister for Economic Development, the Honourable Dr. Grant Gibbons, to say some words of welcome. Thank you.
Thank you, Arthur. Ladies and gentlemen, good afternoon. On behalf of the Bermuda government, I'm delighted to welcome you to the 8th annual PwC and S&P Bermuda Insurance Conference. But I assure you I know my place. According to former Governor Mario Cuomo, giving opening remarks at a conference was somewhat like being the body at an Irish wake. They have to have one for the party to begin, but they don't expect you to say very much. So, let me start by saying what a pleasure it is to see such a high caliber group. The perspectives that I'm sure you will share over the next few days will undoubtedly help the future of the industry as it meets new challenges, adapts to change, and seizes opportunities, whether it be low renewal rates, new business models, or capital convergence. I was also pleased to see a good proportion of the panelists and companies represented on the program are actually based in Bermuda. It may strike you as odd to hear me say this, but from my perspective, it's a very positive sign. It's positive because it speaks to the health and vibrancy of the insurance and reinsurance sector in Bermuda. In my view, Bermuda has evolved a very successful insurance and financial center because of the critical mass of intellectual capital that has been built up here over more than 70 years. For many companies, mind and management are here and on the ground. And I can tell you, the government of Bermuda wants to keep it that way. We understand the importance of that intellectual capital, both Bermudian and non-Bermudian, to our island's long-term success. Well, this may not be news to many of you. Less than a year ago, Bermuda had a change of government. I'm here to represent that new OBA government as Minister of Economic Development and tell you that we are working very hard to help make sure that your industry is successful and that you continue to see Bermuda as welcoming and a good place to do business. As many of you will know, that is the reason we have made a number of changes in the last few months to our immigration policy and legislation to help protect that intellectual capital and make sure we remain competitive and a first-rate jurisdiction. It is also one of the reasons that as a new government, we have worked closely with our local industry leaders to establish and fund the new Bermuda Business Development Agency, the BDA for short, a public-private partnership designed to help promote Bermuda and sustain our growth. As many of you will know, Bermuda is known for its innovation and acumen in risk management. We are proud to be the #1 domicile for insurance-linked securities and captives. Bermuda is the 3rd largest reinsurance domicile in the world. We have obtained this position by constantly augmenting, reinventing, and reinvigorating the product. And of course, many of these themes are part of the program that PwC and S&P have put together to focus discussion over the next couple of days. Our government is working alongside our regulator, the Bermuda Monetary Authority, and the private sector to ensure that we help to create a flexible and accessible platform to enable you to conduct business, incubate, and crystallize commercial ideas, and feel welcome and attracted to doing business in our jurisdiction. Hopefully, you have also realized that Bermuda's location is incomparable, as it lies between London and New York, providing easy access to two of the most important financial centers in the world. Bermuda has a well-educated local workforce and a deep well of sophisticated local service providers, honed by over 70 years, as I said, of meeting the needs of successful international businesses. Bermuda is the intelligent choice. So, if you are not already based here as a company and feel you should be, we hope you will consider making that move. We're looking to grow our critical mass and add to our intellectual capital. Let us know, and we'll put you in touch with our new business concierge service to help pave the way. Now, after that unashamed sales pitch, I would like to take this opportunity to thank the delegates who have traveled from overseas to experience what we have to offer, as well as those who live here. We are grateful to your tireless efforts to ensure the success of Bermuda's international business sector. I know that you will have a great opportunity over the next few days to discuss the views of many of your industry leaders, to network, and to create new business opportunities. Many thanks to PwC and S&P for organizing the event, and I wish you all a very successful conference. Thank you.
On my left is Kean Driscoll, Chief Executive Officer of Validus Re Limited, which is the reinsurance arm for the Validus Group. To his left is Bryon Ehrhart, who is the Chief Executive Officer of Aon Benfield Americas and also Chairman of Aon Benfield Securities. To his left is Kelley, who is the Chief Executive Officer of Ironshore Group. So before we start, as Greg mentioned in his introductory remarks, that alternative capital has been affecting the reinsurance industry. The influx of this capital came in over the last decade, but it seems that the trend accelerated over the last 18 months or so. So the first question, I will probably turn to Bryon and see how, let's say, this alternative capital that everybody's talking about and how it has affected the industry over the last couple of years or so.
Sure, thanks. Well, I think it's been net positive impact. It's brought more choice to clients. There's no question that the cost of bearing the most intolerable risk, catastrophe risk, has gone down. So the opportunity to present our clients with further value in risk transfer, has improved greatly in the last 18 months. But you're right, we did our first cat bond in the firm in 1996. So it's been around for some time. Now we're seeing a substantial difference in price versus what we did the original transactions for. And now with sharp ratios into the 20s and 30s, it is competitive with traditional reinsurance. Traditional reinsurance is still the prized tool of clients, with this product being complementary to add additional capacity and in some cases term in terms of years that traditional reinsurers haven't really heretofore been that comfortable with. And so the additional choice has improved the opportunity for our clients to pursue their interests.
Thanks. And Kean, how would you see that from a Validus perspective?
I'd largely agree with Bryon. I mean, we're an active participant and sponsor of third-party capital through our AlphaCap brand. It's an important component of our overall franchise. From our perspective, it allows us to bring additional solutions to our customer base. We can leverage third-party capital to offer more substantial limits. We can bring in alternative cost of capital, and we can provide diversity of credit. And those are all things that that our customers have asked for and continue to ask for. That said, I think the concept of convergence and ILS has probably reaped too much attention as of late. I think the competition we see in the marketplace isn't purely an ILS phenomenon. I think we're seeing traditional rated balance sheets strengthen from reinsurers. I think we're seeing our client base, their balance sheets have strengthened and they're buying differently. And ultimately, I concur with Bryon, the traditional reinsurance product, given the promise to pay, given the flexibility associated with that, is ultimately more compelling to the vast majority of our clients based on our feedback. But ILS as a complementary component of the overall industry is something that's really important, something that we've been very actively involved in.
Thanks. And Kevin, from, let's say, a primary insurance perspective, how do you view this additional capital coming to the market? How is that affecting your business going forward?
Well, as a buyer, particularly a buyer in a relatively young company, we welcome additional capital coming into the reinsurance marketplace, providing it stays in the reinsurance marketplace. Whether you call it alternative or whatever name you want to attach to it, it's new, additional capital that's coming into a very meaningful segment of the market. We have an underwriting agency at Lloyd's called Pembroke, and we have launched a new syndicate that is capitalized by name capital. And while name capital is the oldest capital at Lloyd's, there aren't many new syndicates being launched with that type of capital. So whatever you wish to call capital, you can debate the name and the reason why it's coming into the marketplace. The relevant point is that it's new. And generally, new capital that wants to enter the insurance business has historically come in through the reinsurance market because it's the easier end of the business to get in. The barrier to entry is considerably lower in the reinsurance market than it is in the insurance market. It's just our end of the business tends to be more difficult to build franchise value, and as a consequence, new capital tends to not enter that into the market at first. So I think that this new capital will ultimately get return, or it'll go elsewhere for that return. So it's clearly the ebb and flow of I think what we're seeing on the global scene, which is in general an oversupply of capital that is going to find homes in different industries.
Yeah, over, let's say, the last decade or so, there was about $40 to $45 billion of this alternative capital that came to the market. And it seems that in terms of the discussion with some of the Bermudians over the last few months, apparently it's somewhat plateaued in terms of, let's say, reinsurance companies managing that additional capital. So they're somewhat pushing back because they cannot deploy that capital. Bryon, do you see that as a trend, or this is maybe just a few players raising this issue?
I guess I'd see it as not in any way close to a plateau. I would say our forecast for the next 5 years is there's 100 billion more of this that shows up in the industry, and reinsurers, instead of looking at necessarily why their product is better for the client versus this, they're going to start using it as, like Kean's company has already begun integrating it into its value proposition to customers. You'll see more of that. Certain companies have been leading that charge, others have been slow to follow, but the debate is, I would say, in boardrooms here, relatively over, and it's now about how do we progress this new capital flow that lowers the cost of underwriting capital in the tail and throughout the risk distribution in terms of sidecars and cat funds, and then managing ILS funds. Reinsurers do have skills and opportunity to add quality to that field as well. So we think all three of those aspects will be in play as the next 100 billion enters. And with what Kevin said, I think these low interest rates are what's driving it, and it's driving it to the point where the comparative credit yields versus reinsurance are still quite attractive. So our 5-year forecast is based on input we receive from other divisions within Aon that actually advise on pension funds about how yields are necessary to match pension obligations. And our affiliate Aon Hewitt advises on about $4.3 trillion worth of those pension assets. So we have taken the time to gain that insight in terms of their interest in not just the insurance space as a diversifying asset class, but all of them. And we're one of them that actually remains pretty attractive. So we anticipate much greater flow, and reinsurers beginning to lead and manage that flow rather than resisting it.
And Kean, from, let's say, your perspective, I mean, with AlphaCat, you're managing almost $1 billion in terms of third-party assets. Prospectively, you see, this flow of alternative capital to the reinsurance market slowing down, or is it, the momentum is still there?
I think there's a temporary slowing, and I'll equate that to the first $45 billion that has come into the market has largely been channeled towards certain segments of the market. First, it's almost exclusively nat cat at this point. The retro segment of the property cat market is now, close to 100% ILS supported, right? Maybe 90, 95%. I mean, it's a huge percentage of that market, and there's a natural reason for that, and that's typically funds coming from the hedge fund, and to a lesser extent the private equity side, not so much the pension funds. We also see money come in that's typically targeting a bit more remote risk, and that's largely manifested itself through catastrophe bonds. Where we're running into, I think, a natural evolution of fund inflow and outflow into the market right now is as new capital comes in, the retro market is saturated. The cap-on market, I think, probably still has a fair amount of headroom, but money's looking to come into that sort of traditional reinsurance space of, the average rate on line of 10, 12%. And I think clients are prudently determining how much of their program they want with non-traditional capacity. And there's lots of different reasons you would want ILS, and there's lots of different reasons why you would not want ILS. And traditional reinsurers are trying to rationalize the sponsorship of that capital. We're in a rate descending environment. There's not a lot of increased demand. People are struggling with the ability to deploy capital and not cannibalize their own balance sheets. And so I think that's the dynamic we're dealing with, but there'll be a work through of these issues, and I'm not going to project that there's additional $100 billion in because we haven't done that work, but realistically we'd expect the number to get bigger over time.
Okay. And Bryon, would you expect that this alternative capital will move to other lines of business, or mostly focus on property catastrophe risk at this point?
I think it's going to have some potential to move to the other lines of business, but I think that form of alternative, I would say, it would be much more in the hedge fund managed model, where the expectation for return on that model is actually very, very low. Because if you ask me, as a treaty reinsurance broker, if there's sufficient capacity for everything but cat in the reinsurance market, there's more than sufficient capacity. Today, the casualty reinsurance market for treaty is probably half of what it was 7 years ago and a third of what it was 10 years ago. So the value proposition of treaty casualty reinsurance has continued to erode, frankly, not really through any fault of the reinsurers. It's just that the frequency has continued to decline, and severity has been quite manageable. So people like Kevin have been able to underwrite good business and receive those benefits. They've been keeping more and more of it net.
Okay. And Kevin, in terms of, if we can switch gear to pricing, and there's two stories. We have the reinsurance pricing and then the primary insurance pricing. I mean, on the reinsurance side, we've seen increased competition, even in non-cat lines of business. On the primary side, at least in the U.S., we've witnessed, let's say, price increases year to date. But then it seems that over the last quarter or so, that momentum has been somewhat declining. What is your view in terms of insurance pricing, let's say, at least in the U.S.?
Well, the market right now is quite good. Obviously, the low cat activity has aided ROE results. The cat loads that most of us carry have not been fully utilized, so that's provided some additional margin that you can't count on in 2014 and 15. But from a liability perspective, I think there's two things that are rather dramatic that are going on today. One, and they both emanate from the same source. Low interest rates are forcing underwriters to underwrite. In order to get a double-digit return In today's world, you have to underwrite to a 90 combined on an accident year basis. The evidence of 2% new money clearly drives you to that conclusion. So my belief is that as long as interest rates are at maybe 3.5 or less, we'll continue to see, that's 10-year U.S. Treasuries, we'll continue to see, I think, pressure for insurance companies to underwrite, particularly if there's any kind of normal catastrophe activity which would potentially impair those cat loads. But the other thing that's occurring, and as I said, they're both based from the same issue of oversupply, is that economic inflation, particularly in the West, continues to be very, very low. And that's very positive for reserves on casualty business. So what we're seeing is this notion that underwriters have to underwrite, but the environment that they have to execute is a very good environment, because with economic inflation being low, at least in the United States, it appears that medical inflation is lower. So we're seeing this environment where the threat to current loss reserve positions seems to be mitigated and benign. So right now, things look pretty good for the front end business, for the primary insurance business. I just want to make one additional comment about capital inflows coming to the business. Because interest rates are low, pension funds and other potential sources of capital are chasing for yield. And that's giving rise to this new quote-unquote alternative capital, which is giving rise to untraditional reinsurance solutions. And what is interesting to me is that pension fund money is bypassing, not exclusively, but to a larger degree, the traditional pockets of how the industry would, or how the private equity industry would otherwise invest. And so what you're seeing is this attempt by pension money to bypass the traditional gateway, which would be private equity and or hedge funds, into more of a direct kind of relationship. So that's an interesting dynamic, I think, that will continue to play itself out.
Thanks. In terms of the discussion that took place back in Monte Carlo, it seems that pricing, for at least for property U.S., expect to be down 15% next year, and then for European property, probably flat to down 10%. Kean, from your perspective, looking forward, given the current market environment and all the excess capital that it's available, how do you, let's say, project, pricing for the next maybe 12 months?
Yeah, I don't want to negotiate against myself. So, clearly, there's a supply-demand imbalance that's probably most obviously manifesting in pricing behavior in the U.S. I'll change tack a little bit. I think that the story that's not discussed most often is that because there's a supply-demand imbalance and because there isn't incremental demand created in our marketplace, particularly on the property side, which is something that collectively as an industry we should address. The big issue right now is going to be carriers' ability to access business, because even with price erosion, there still are attractive margins. We do think that the business on the whole still offers attractive returns, but one's ability to get the best signings on the best programs is what we think in both the near term and the long term is going to create differentiation amongst reinsurers and those who outperform and those who underperform. So I think there's a real challenge right now with size and scale and distribution and value-added services. That's the message I think that folks who are looking to value reinsurance franchises should be focusing in on. Price will be price. It's a simple supply-demand, sort of economic elasticity issue. But the value-added services that a reinsurer can bring, the insight, the service, that's where I think true value is created.
Okay, great. It seems that even without the alternative capital, the insurance companies and reinsurance companies are well capitalized. And in terms of the industry, should it stay and wait for, let's say, demand, or the industry by itself should create demand, be more innovative? And we delve into Bryon and see if there are any products in the horizon that probably we should be, expecting.
Oh, I think there are a shortcoming of new demand for traditional reinsurance product. I think that some of the model changes or events are the things that generally drive events. And the last events, really in the whole 11 and 10 series, you really didn't see clients challenge the top of their reinsurance program as they did in Katrina, that resulted in additional demand. You had some model changes in the last year that didn't really sink in as new demand feeders. Some of the rating agency changes that are pending do have some additional demand, but we are getting the insurance and the reinsurance industry to a point where each are taking less risk per unit of capital than they ever have, and that hurts the value proposition on the original insured side. And we need to be careful not to over compartmentalize the capital requirements such that we get there, unless there's a complementary set of capital requirements or stress tests that occur on large corporations, for example, that are issuing record amounts of debt in a low interest rate environment. And more than half of the S&P 500 has increased their debt to total capital since 2008, not decreased it, but increased it. And they've done that at a time where there's no S&P or Moody's or other requirement that says, hey, how about looking at how insurance benefits the interest coverage ratio or the debt to total capital ratio. When untoward events happen, there is coverage, and that's the value of insurance. It's not recognized as S&P or Moody's rates bonds for those corporate issuers in the same way that reinsurance is looked at when S&P or AM Best analyzes an insurance company's balance sheet or even a reinsurer's balance sheet. And if there were complementary stress tests like that, I think we would actually see more demand, because insurance then would more often be thought of as something that pays for itself because it has an economic benefit, lowering debt costs, lowering the cost of operating or financing their businesses. And for whatever reason, the rating agencies haven't made those links together. There's a similar example on the personal line side with Freddie and Fannie not requiring earthquake insurance, and that would balance the reinsurance equation, at least in most likely the insurance equation as well, if we had that peak as a dual peak for the current highest peak being U.S. hurricane.
Yeah, some of the large companies, especially let's say there's BP and the accident that happened in the Gulf of Mexico a few years ago in 2008. Yeah. It seems that sometimes the size of a corporation may help it not to buy insurance. That's the argument of some of the large let's say corporations. But insurance brings value in terms of protecting from, let's say, severity risk.
Yeah, but my point is that even the largest corporations participate in the debt markets the most.
Yeah. And
they would even see more value in the insurance product if it were given credit in kind of events that, it's clear now, you can have a $100 billion liability happen to a single non-insurance entity, right? And that's another case in TEPCO within the same year, actually. So there are ways that at rating agencies, it's not an everyday experience that you have a company like BP to get downgraded 4 notches. Right? That's not supposed to happen, right? And then at TEPCO being down 16 notches, right? That's not supposed to happen. If there were stress scenarios that were brought to bear saying these things shouldn't happen, how are you what are the provisions you've made as a corporation for those things? You would drive demand for insurance, and you drive demand for reinsurance.
Thanks. And Kean, from your perspective, it seems that, you do write, let's say, terrorism risk through Talbot, one of the largest Lloyd's syndicate. And I know that Ed Noonan has been very vocal during the conference call of third quarter about terrorism risk. How are your Validus view on that risk and potential business there going forward?
Yeah, so we write political violence or terrorism through our Lloyd's syndicate, who's the largest writer of political violence by income within the Lloyd's market, and has been writing it for, I think, 12 years now. But also, we write treaty reinsurance for terrorism through Validus Re, and it's difficult to measure, but I'd argue we're one of the largest writers of terror reinsurance globally. So we are of the view that, as I mentioned earlier, the industry needs to create demand, and one of the obvious areas from our perspective relates to conventional terrorism, and conventional terrorism specifically in the U.S. I think the industry has not served itself well in some of the recent testimony before Congress in saying that conventional terrorism cannot be priced. We firmly disagree with that view. There is a $20 billion global terrorism market that exists in the treaty side, $7 to $8 billion that trades just in the U.S. We have, as an industry, committed a substantial amount of resource since 2001 to understanding how to price frequency around conventional terrorism risks and understanding severity and the hazard components and the financial models associated with loss as it arises from conventional terrorism. So we're of the view that the market could bear more conventional terrorism risk. We've raised our hand and said we're willing to do so. We know that a number of our peers in the industry are also willing to do so, and that the role of the government within TRIA should truly be limited to a great extent to nuclear, chemical, biological, and radiological events, and to some extent cyber terrorism, where the quantum of loss, the severity of loss, is unknowable and thus, from our opinion, uninsurable. But beyond that, we think there is potential unmet demand from the private market side to increase the footprint on terrorism.
Thanks. And Kevin, given that TRIA will be expiring by the end of next year, how would that impact in your view on that risk and whether you're willing to write it and price for it?
Well, we've just announced through our Pembroke syndicate a consortium of $300 million of capacity for the terrorism exposure. So our preference is to take risk, that type of risk, through that mechanism if indeed TRIA is non-renewed. I agree. I think the industry can provide a very, very meaningful, if not limit, at least supplement to what might get resolved in Washington today. But to the notion of innovation, innovation, in my opinion, is fundamental to our business like it is in any other business. And it's been my history, at least in the West, that innovation generally comes from a change, and generally it's a change in law that impacts clients, and that creates a opportunity for us to provide a coverage that is new to the client, and also services that help mitigate that exposure for the client. A great example of that was in the early 90s when employment obligations changed in the United States. We developed an employment practice policy at my old company, and we in effect transferred risk, but probably just as importantly, we educated the client about the change in the exposure and how to mitigate that exposure, and baking in a loss mitigation component right into the new product solution. Awful lot of change occurring in the United States that'll emanate from the Affordable Care Act, and so we're designing products as we speak for that, And the key, I think, to innovation is to create a structure that allows you to truly understand the client's perspective on change. And so we're doing that now through the initiation of several industry practice groups that will be a third leg, so to speak, on how we address the market and dealing quite directly with our clients and trying to understand their needs and help them anticipate change and ultimately helping them adapt to change.
Yeah, as you know, Greg was mentioning in his remarks earlier that the growth in the developed world is positive, but still, at slow rates. And S&P still projects, let's say, high growth in the developing world. But I mean, they're at slow rate, given that they've been impacted by what's going on in the Western world. So in terms of, let's say, seeking growth, in terms of the top line, there are certain markets where, let's say, Validus is looking at in terms of generating that, additional growth when it comes to reinsurance or insurance through Talbot.
Yeah, whether it be through Talbot or Validus, I think from our perspective, the two obvious areas with respect to emerging markets are, like well established, but it's Latin America and Asia. And from our perspective, Asia is largely a story about China. I think, we look at the near and intermediate term. The opportunity from our perspective is more on the insurance side. The challenges around reinsurance are just the penetration rate and the GDP per capita spend on insurance are still relatively low, and so you're not seeing true excess severity exposure, and that's really where the reinsurance market generally shines. I think China is getting close to that. There's a tremendous amount of value in parts of China where earthquakes and typhoons can present real challenges. In Latin America, and we saw that most recently in Chile. So we see limited opportunity in the near term in Latin America and in Asia, but over the long term, we think there's some really compelling opportunities there. The big challenge from our perspective is just educating our customers and increasing insurance penetration rates and really focusing on data quality. And those are the areas that I think emerging markets need the benefit of more developed markets to kind of help them along in those respects. But those are the areas we're largely focused on right now.
Bryon, given that we talked earlier about alternative capital and ILS and other types of products, do you see growth in the non-U.S. regions in terms of those alternative products?
I think it'll eventually get there, but certainly some of the new sidecar capital has been already attracted to Chinese agriculture business, as an example. So everything that Kean said is exactly right, but very focused opportunities like agriculture. The challenge of feeding 10 billion people largely has, China's have to have a big role in that. And the crop insurance by province that's being rolled out across China, and we've got our second edition of our crop model there. And anything we can do to make the risk more transparent for both reinsurers as well as alternative capital. It's going to be a long time before that's a real needle-moving kind of business, as Kean was indicating, I think, but you have to be there early. There's a lot that's developing, and it does create greater opportunity.
The Chinese agricultural market is probably the best microcosm of what we're seeing in Asia right now, where that market is increased tenfold, I think, over the last 6 or 7 years. It's the second largest global agricultural market, but every quarter there's a new province or a new crop brought online. So there isn't a robust historical data set in terms of frequency or severity. So it's a challenge, but it's a challenge, I think, well met by the insurance industry, who's pioneered risk transfer solutions in, a variety of territory and risk classes, I think we're up for the challenge.
Yeah, if I can kind of switch, there are some developing markets, even in mature markets. If you look at, energy independence as a topic in the U.S., there's a substantial set of values being built along the U.S. Gulf Coast to export LNG that are anywhere between $4 and $12 billion, $20 billion kind of facilities in very focused areas. And those kind of facilities are being told by the insurance industry broadly that there's $250 million worth of coverage that's available. And it's a huge opportunity that I think missed by the insurance and reinsurance community together in terms of making sure that our value proposition, there's actually far more capacity than exists in a limited market for that type of product. And we can meet the requirements of that market. So there's, that whole topic of things we should be focused on that are actually growing even in mature markets. And the way we address that, I think maybe Kevin's got perspective on that, but there are some interesting pockets like that we can do a better job of articulating our value proposition as an industry.
Kevin, in terms of Ironshore is a global insurance company, and so how is your approach in terms of developing markets when you enter the market for the first time or initiating a product there? How is your approach to that market?
Well, 65% of what we do is done in the United States. So obviously, that means 35% is not. I was just in China last week and spent the better part of 9 days traveling to India, Hong Kong, and China as well. And I think the thing you learn from traveling to Asia is that sweeping generalizations are indeed dangerous, because the market in Hong Kong is very different than the market in mainland China or the market in India. And I do think that what is required in most foreign markets is persistence and determination. Markets are showing pretty good economic growth, as you've pointed out, but the participation rates vary from country to country in terms of how they buy and why they buy. But our approach is reasonably simple in all our businesses. And that is to fundamentally pick businesses that we think we can achieve scale and influence in, and businesses that we believe carry margin that's sustainable over an underwriting cycle. And then we take those businesses and try to apply those businesses to a global platform. And so that when we do enter a market such as Singapore or Australia, which obviously has very different dynamics from each other, we go in on a highly focused basis with a reasonably limited investment in terms of people, and really attempt to develop that focus in a meaningful way and gain an edge in the market in that one or two or three product arena. And we've done that successfully in Australia, and we've taken a particular product, reps and warranty, and we're a market leader now in that area, and principally throughout all of Asia Pac right now. So that's how we view things. But I will say that when you go to Hong Kong and you go to the mainland, and we go and we schedule meetings with insurance companies, brokers, and we fill our day up. And so it's a lot of step-by-step blocking and tackling. We find that when we do it, we always learn something. Obviously, we didn't know before. And two, we uncover deeper relations by doing it each time than we did before. And we do think that every time we go, and this is my second trip to Asia this year, we unlock some potential opportunity that we just didn't see before. But having said all that, that region changes. It changes as we speak. Therefore, you have to be very committed, in my opinion, to building a business there. And not many have done it from the West. What we are seeing is that most of the Chinese insurance companies are clearly beginning to develop a clearer focus to the West. And when I first started going, and it was only 3 years ago, that clarity wasn't there. And now you're seeing a very clear desire to be in and participate in Western markets. But that still is principally London, as opposed to Bermuda and the United States. And so we'll see how that evolves. My guess will be that it'll evolve slowly, because I do think most, particularly Chinese insurers, are very cautious. We did see that PICC did support the Willis 360 initiative. And I think that's an example of how the Chinese are beginning to think about the West and how they plan on potentially participating. So the Chinese are very different in how they view the West. The Japanese are very different in how they view the West. And right now, I think Hong Kong, while it's a very competitive market, is probably a market that suits us a little bit better than maybe those other two do. So we are likely to open an office in Hong Kong, probably sometime in early 2014.
Thanks. If we can talk about earnings, when we've been talking to industry executives over the last few years, they keep, targeting, let's say, 15% return on equity over the cycle, or some percentage point above, let's say, the risk-free rate. However, over the last few years, it seems that the target was not, let's say, was not met. In terms of, Kean, what your perspective on the industry, let's say 2013 and 14, what type of ROE the industry would achieve?
It's hard for me to characterize the performance of the industry, but thinking about our organization and thinking about how we position our portfolio in context of ultimate returns. We've had the good fortune of exceeding or meeting 15% ROE over the last couple of years. We've got admittedly a short tail focus, and when the weather gods bless us, then our ROE shines. But over the long term through the cycle, we tend to think about it as 1,000 basis points over risk-free rate. Now, I think the challenge for us today is the risk-free rate is fairly anemic. And if you go back to when we started the company in the end of 2005, 2006, we're probably looking at 2 to 4 ROE points that sort of slipped away on the investment side, and that's really from a short tail company without a tremendous amount of leverage. I think that's the dynamic we're seeing play out in the marketplace right now. It's just a lack of sort of exciting or meaningful investment returns. But the core underwriting principles, if you're targeting somewhere between 1,000 and 1,200 basis points above a risk-free rate, I think there's a fair amount of commonality in the industry, and that, from my perspective, hasn't changed.
And Kevin, from your perspective, how the industry would perform prospectively?
Well, I guess what is called into question with Washington's continued dysfunction is what is a risk-free rate. We think it's the 10-year Treasury, and I think that's a pretty good way to look at it. Overall cost of capital is down, and so therefore, while I'm sure we would all love to have a 15-point return on equity, In today's world, with 2 to 2.5 points coming in on new money, that probably isn't realistic. So if the 10 years at 2.75 or maybe 3, then maybe a 12.5 to 13 is a pretty acceptable target. So, but the real challenge for the industry is achieving that. Most projections, at least that I see for public insurers for 2014 and 15 is return on equity below 10%. So we can all agree on a proper target. The trick is carrying out the execution to reach it in a market environment that I think will be changing and will be challenging and will require, in my opinion, a lot of experience and discipline.
Thanks. And Bryon, in terms of, let's say, at least for the Bermudian companies, the stock prices came back significantly, let's say, in 2013. And on average, they're trading around book value. What explains why these stocks are somewhat undervalued compared to, let's say, the market?
Well, obviously a big question, but I think there's a realization that the relationships that these reinsurers have with clients are important, and that the advent of new capital that costs 5 to 6 to get rid of tail risk versus an expectation before of if it was 10 to 1,200 basis points above risk-free, there's an arbitrage that can be played there, and it will play out in terms of people will swap out in our 5-year projection, incorporating the next $100 billion of this. There's a decent amount of swap out of existing capital and consolidation, so share repurchases, extraordinary dividends, and actual consolidation that causes reinsurers to probably become somewhat larger, but swap out probably more intelligently the risk that can be securitized over a reasonable planning horizon, 3 to 5 years. We think that product lives well inside of a reinsurer versus an insurer, but insurers are obviously going to play through that as well. So they'll have the opportunity to do that. I think there's an expectation in the market that certain participants will be winners in that transition, but it is a structural transition that we see.
Okay. And given that we talked about excess capital in the market, alternative capital coming to the market, prospectively, do you expect some consolidation within the market in general and the Bermudians in particular, Bryon?
We do. That's in our 5-year projection for incorporating the $100 billion in. We think there's meaningful consolidation space in the industry. And some of these products actually lend themselves to a little bit larger platform. It's not that the existing platforms aren't larger, but the smaller of those platforms probably can gain more efficiencies for their shareholders by combination. And I'm leaving out the whole personalities discussion because that is separate, but just economically it would seem to make some sense to, if you want to drive the kinds of shareholder returns that I think Kean mentioned still can be made with the, I'd say, additional capital, and maybe not so much excess capital, just capital that needs to be incorporated in to take existing common stock form equity capital out.
And Kean, from your perspective, you think we'll witness significant consolidation going forward among the Bermudians?
I agree with Bryon. I think there's probably all of the elements there for consolidation. There's a real challenge in the marketplace. From our perspective, what we see is a dynamic where, particularly with short-tail focused reinsurers, the market is evolving into a bit of an oligopoly where the bigger players are able to invest more in their business, are able to offer more meaningful capacity, and thus are able to drive better signings or better overall returns. And so it's self-fulfilling philosophy. So I think it's becoming more and more difficult to be a smaller player, whether that's in Lloyd's, whether that's in Bermuda, or whether that's as an independent managed ILS fund. So I think from that perspective, I continue to see that trend develop and grow, and I think that naturally leads to the need for consolidation. You couple that with the fact that in a circumstance where there's excess capital, you're going to want to, one of the levers you can pull is managing capital, whether it be through share buybacks or special dividends. But I would be concerned that you shrink to the point of being irrelevant. I think there's a real challenge in the balance of the size of a company, but at the same time, you need to be able to source enough good business to feed that capital. So there's a real balancing act that's going on in the industry right now, and I think the people that are going to fall on the wrong side of that balancing act are probably naturally going to find themselves leaning towards M&A as a potential solution.
Just to follow up on that, when you say you need to be a certain size, otherwise you become irrelevant, is there a particular profile that you need to reach to be able to have access to all business, or at least the business that you would like to write, whether it's from a capital perspective or product diversity or geographic diversification?
I don't think there's a magic number. I mean, we're about $5 billion in capital, so it's somewhere around $4.75 billion, I think. It's hard for me to answer the question. I think that's a better question from Bryon, who's more closely attuned to the buyer's needs and wants.
Yeah, so it's a in the levered and rated model. You know, you're in that $2 billion and above kind of is critical to have a $20-25 million line quoted on a particular account. I think is not too far out of where things are today, but obviously we're finding ourselves dealing with a lot smaller entities today with the emergence of roughly, let's call it 18 new markets in the last 18 months. And when you're collateralizing, so it's a not a levered model, it's in a not rated environment. Clients are open to the idea of incorporating them into their reinsurance programs. So it's interesting as a broker that you have a tolerance on the collateralized product to deal with far smaller entities because it's fully collateralized. But if you're going to take the levered and rated model, which is really our definition of convergence, is where levered and rated is equal to the price and value proposition of the collateralized market. And that to us defines convergence, and we're kind of moving past convergence now. And it's the part where we see much greater incorporation by reinsurers of sidecars, of cat bonds, and asset management.
Thanks. And Kevin, from your perspective, do you expect, let's say, consolidation among the, whether the reinsurers or the primary insurance?
I think it's very hard to say because I joined Ironshore 5 years ago, and the notion of consolidation would always come up in panels like this that I participated in, and for every year that I've been with the company, the answer in these panels, the consensus was, this is the year, and it's never happened by and large. I really do believe that the new dynamic today is execution, and that there is no right size as long as you can effectively compete. There are a lot of companies that are much bigger than us, but we feel that we can effectively compete with many of them. Because we're highly focused in what we do, and we believe that we have influence in the products that we focus on because of the experience that our management has in those respective product lines. And I do think the real issue with consolidation is it has to truly be good for both parties. And there are some obvious targets, I guess, that always get presented to me from the investment banking community. But frequently, the way I look at some of those is that, well, whose problem am I solving? Am I solving somebody else's problem, or am I really advancing Ironshore's strategic view of the world? And so consolidation, I think, to be successful, has to create some sort of leap for the two companies involved in order to ultimately be a quote-unquote positive game changer. And I don't think we've seen that yet, at least in the 5 years that I've been involved. Frequently what you see is somebody buys somebody and they, you know, in effect dismantle the company and they take the assets and they do some other things with it. So whether or not we see that kind of game change consolidation on any kind of sustained level is really beyond my view today. But I do know that in order for a company like ours to succeed, we have to be extraordinarily good at what we do.
So I'll go back to Kean in terms of, let's say, talking about investments. It seems that in general, let's say the Bermudians tend to have conservative investment strategies. Yeah. But at Validus, did you change your, let's say, your investment strategy given the low interest rate environment, or it's still the same?
No, we've maintained a very consistent and very conservative investment philosophy. Again, with a short tail focus, with a heavier emphasis on natural perils, it's paramount that we maintain liquidity on behalf of our customers. You know, we also have a guiding principle that we never want a scenario where the CFO walks into an underwriter and says, put your pen down because XYZ's happened in some segment of the financial market. So we've maintained very short duration. You know, the expectation is there's some potential volatility in the interest rate environment. We want to be well positioned for that. I will add, as we've gotten bigger as an organization, it's given us more flexibility to explore alternative asset classes, but with relatively modest percentages of our overall investment portfolio. But generally speaking, we continue to maintain short duration, high credit quality, very conservative investment philosophy.
And Kevin, same question.
We think it's tough to take risk on both sides of the balance sheet, so to speak. So we've maintained a very conservative investment portfolio. You know, we've grown the company considerably, so we've had the advantage of a lot of positive cash flow over the last 5 years. But you know, we continue to invest that new cash flow at about 2 points or 2.25. So it's really put the challenge, as I said earlier, on the underwriting side of the house, which we think is good. We think that discipline is a very, very good discipline. I do think that every model you see out there does tend to take a view that if you're going to take asset risk, you somehow have to limit your liability risk. And so it's a question of really how you judge your own critical skills. Probably the only great exception to that is Berkshire Hathaway, that seems to take risk on both sides, but they're probably fairly unique in their ability to be able to do that. So we'll continue to explore, but we will not chase yield.
Thanks. And from your perspective, Bryon, do you see any trends in the market in terms of reinsurance companies adding more, let's say, or allocating more of their funds to non-traditional type of investments?
Yeah, the trends are pretty well documented. They are allocating more to alternative investments, and it may not be chasing yield. It might just be looking at some alternative asset classes that you know, just diversify their sources of returns. You've seen some greater flows back to hedge funds from insurance companies and reinsurance companies, as well as, you know, still allocations, I'd say, to private equity from insurance companies outside of the insurance space are up as well. So I think you'll continue to see boards and shareholders push management to at least explore in a low interest rate environment. Is there anything that is actually reasonable still to do that could compound capital faster for us without, you know, again, emphasis on reasonable. Certainly our clients expect, as you've heard from these gentlemen, very reasonable approaches to the asset side. But I think as you look at other insurance vehicles coming into the marketplace that do have much more aggressive management style and less aggressive insurance risk underwriting style, that some shareholders, some board members say, how do you kind of make both of these worlds a little bit closer without ruining either one?
All right, so maybe just in terms of closing remarks, I will turn to start with you, Kean, in terms of your outlook on the industry for the next 12 months. Is it positive, stable, or negative?
I think it's, we always have a positive view on the market. I think there are elements of our business that we're experiencing, probably more competition than we have in our history, albeit brief history. But we're terribly optimistic about the potential to combine new sources of capital with our own capital construct and our creativity, and ultimately to create value for our customers, and then for our shareholders. So we're quite bullish. We think there's a lot of interesting ideas out there that we are incredibly well positioned to capitalize on. And
Kevin, what is your view on the?
Well, I thought I was going to go last, so I thought I actually had the right pick here. But it's a very interesting question, obviously, and I personally view that we're in for a protracted period of time where interest rates will be low, and the corollary to that is that economic inflation will be low. So one challenge is offset by, in my opinion, a benefit. Having said all that, I do think 2014 will be more challenging from a competitive standpoint, both on the insurance side, though to a lesser extent than on the reinsurance side. I think the reinsurance market's going to, unfortunately, be caught in a dynamic that is potentially not favorable to them, in that supply is increasing, and for a whole series of reasons, demand is actually decreasing. We tend to be a long-term buyer of reinsurance, so obviously we're reasonably consistent in how we view the market, at least from our standpoint. So we want to see a healthy market going forward. So I think the biggest risk in 2014 and 2015 is execution, and I do think experience matters in markets where execution is the principal risk. There will be, in my opinion, differences in performance, both between the primary market and the reinsurance market. And I think there'll be differences in performance among the primary insurers, because not everybody will be in the same position to execute.
Thank you. And Bryon, you have the final word.
Yeah, well, I'm very positive, very optimistic about it. And I'll say the first signs that you really see in this renewal season are that reinsurers have shifted the conversation. Traditional reinsurers have shifted the conversation from how do you protect me from risk as a reinsurer to how do we do more together. And I think that is a marked change in this renewal season versus, frankly, anything since Katrina. I think prior to Katrina might have had a little bit of it, but now it's really how do we take what's available in the marketplace in a reinsurer's value proposition combined with the capital flows and help a client actually do more to be less restrictive in places where they have been restrictive. Tell their agents, actually, we have capacity to grow again. So that's an interesting change.
Well, on that positive note, please join me in thanking our panelists.